The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is tax season 2018, officially, and we know what's happening. And so if you have any questions, because let's face it, we're doing 2017 taxes in 2018. We got 2018 rules so that we can get you up to date. So we want to make sure not only do you not overpay your 2017, and there's a lot of stuff in there that you need to know about, but 2018 going forward so that you will be the smartest buckaroo in the block, right?
That's right.
And I have Tiffany Fabian. Hey, Tiff.
Hey there, Esther.
And Christopher Fabian.
Hello, Are you staying warm?
Am I staying warm? Yeah, I am staying warm.
I know you went to see your mom today, and she yelled at you for not having a warm enough coat on.
And I lied to her, and I told her that it was
lined. She won't know any different.
She doesn't listen to the radio.
No.
She won't know. She won't know. But she said, I've been seeing you on TV.
That was so cute. And
yeah,
she
and
said,
by the way, all of our commercials are starting, and so if we've been bothering you, if you just came to see us, we wouldn't bother you anymore, right?
Well,
we're
so
going to
funny.
bother you till you come to see us.
When I do somebody's tax return, they're like, why didn't I do this sooner? I should have done this sooner.
I know. One of our taglines on one of them, you know you want to. People say to me, I've been wanting to come see you for years. Then you just come and you will like it, right? Speaking of that, we have all of our offices are going to be open
33,
up when now?
Yeah.
Okay, we're going to give you breaking news. The IRS has pushed back the filing start. From when to when?
From the 19th to the 29th of January is the first day to electronically file.
Right, Chris?
Yep, they pushed it back a week, but even bigger news is people with earned income credit, additional child tax credit, those refunds aren't going to be released until the end of February.
Right, so that's part of the reason that if you come in and get the refund advance that we're offering this year, if you're somebody that's looking for, of course, the first thing we tell you is change your W-4 at work so that you don't get a big refund.
Right.
But if you haven't, we are offering something called a refund advance. It's an interest-free basically advance on your tax refund, and there is no interest that's being charged. So when you come in, and there's no fee that you have to pay to us. It'll all come out of your refund check. So that's something brand new. All of our offices are going to open up though when.
On the 19th of January, all of our offices are going to open. And I can tell you right now, I've done lots of 2017 returns. I just do the returns and put them on hold, have them sign, and then it's ready to go.
So if you're ready to go, even though the IRS won't be accepting the returns, we will get them ready to go. So in that first minute that the IRS is open for business, your return will be the first one in line and the first one to process.
Right.
And we have some really good news, too. We are growing our family.
Yep.
And we were supposed to grow our family at a live remote in Lewiston.
Ribbon cutting.
Yes, in Lewiston today. But because of the excitement of the Bills game, BEN couldn't do it. So we have our newest addition, the owner of our Lewiston office, Dave Mickey, on the phone. Hey, Dave. Let's see. Dave is right there. Hey, Dave, how you doing?
I'm doing great. How are you?
Congratulations.
Thank you.
So why don't you tell everybody where your new office is in Lewiston?
Well, what I tell everybody in Lewiston is we're right behind or adjacent to Tin Pan Alley, which everyone seems to know. Lewiston is a great community. The word is getting out. Wonderful small business owners in this marketplace, everything from Favorites Pizza to Frank's Computer Fix to even the Howard Hanna people have really been helping us to get the word out. We're conveniently located off of Cayuga there by Tin Pan, and we're
not too far from the post office and Bank of America, right?
Tops.
You could walk right through Bank of America and walk into our store.
Right. And now you're going to be opened up on the 19th as well as all of our other offices, Dave, I'm assuming?
Yeah, we'll be consistent with the EG tax hours of 9 to 9 Monday through Friday, and then 9 to 5 on Saturdays.
Right. And until you're open, though, are you accessible by phone, by cell phone, if anybody has any questions relative to what they should be, especially when you're talking about all those small business owners? That's what we're going to talk about today on our show, is about some of these business concerns, not only employers but employees, with the new phase in and of the passive. It's not passive. It's
the pass-through,
not passive. Pass-through deductions and how they're computed. And so, when you're talking to all those small business owners, that's something that they should be paying attention to, because they would be somebody that could get that pass-through deduction if they qualify. So that's. And in the meantime, where could they get you, Dave?
It's real easy. 272-2000.
Oh, what a great number, 272-2000.
Yeah, and I know Dave was helping a hair salon the other day, right? Talking about small businesses. Weren't you helping a hair salon? I was answering some questions.
Yeah, and a lot of it is just helping people to get organized and not be intimidated.
Right.
What they need to do and what the changes will impact them with. And we're here to put people's mind at ease. And to your point about when we're here, I think I'm here 24 hours a day right now.
Yeah, I know. And it's a lot of fun. I mean, it's a wonderful business to be able to really not only do the work of taxes, but to get people tax planned. And then there's that camaraderie that happens between you and the client. And that's part of, I think, what EG Tax does so well, is we have caring people that work for us. We care, you care, and we just invite people in that whole Ransomville, Youngstown, Lewiston, Wilson, Niagara Falls area to go out and visit Dave Mickey at EG Tax. And your address, Dave?
We are at 765 Cayuga Street, store number 2. And we've already gotten appointments from people from Youngstown as well.
Oh, that's great. Well, we're just wishing you a wonderful Happy New Year. We'll see you at our awards banquet next week, and we're going to take a short break. And Dave, thank you for calling. And anybody that's interested, make sure you stop in to see Dave Mickey. And again, your phone number, Dave?
772-2000.
And then your website?
egtaxoflewiston.com.
And
all right.
Of course, if you go to egtax.com, you're also listed there.
You got it.
All right. Thanks, Dave. Thanks for calling in. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we want to talk about your questions. Specifically, our topic of the day is how small businesses are going to be impacted by this 2018 change in the tax law. And if you're an outside salesperson, if you're a small business owner, if you're wondering how this pass-through works, we're going to give you some pointers as to who qualifies, how the deduction works, how you can make sure that you get it for your business or not get it, or some of the change in thinking you have to do with this change. And again, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break, and we'll be back on the other side. Hey, this is Esther Gulius, the tax lady from EG Tax. This is tax season 2018, and we are going to make sure you don't overpay your 2017 return taxes, and we're going to make sure that you're phased into 2018 correctly. And there's been a lot of questions about what this pass-through deduction is for businesses. And Chris, can you kind of sum it up easily? I mean, the pass-through.
Yeah, easily is kind of a hard word, but let's say you have to, first of all, if you're a pass-through, meaning an S-Corp, a Schedule C, or a partnership, in order to get the pass-through reduction, you have to have payroll besides yourself.
Good. So that's the whole thing. If you're a C Corp, they drop from a top rate down to 21%. So it's like a 14% drop if you were a C Corp, because there's two types of corporations, a C Corp and an S Corp, and an S Corp is a pass-through, okay? The C Corp, people wouldn't want to run out and become a C Corp because in order for you to take money out of the C Corp, you're going to pay taxes on the dividends, so there's double taxation.
Right, so you're right back up to 36%.
Right, so that's why people don't run off to be C Corps. All right. So, but if you're an S Corp, you're a self-employed partnership, they to make things equitable, because they dropped the top rate by 14% on a C Corp, they wanted to give some
incentives.
Incentive to those kind of people. And so they have what's called a pass-through. And the first thing you must have in order to get any of these pass-through deductions, like Chris says, you have to have payroll. Because the pass-through deduction is predicated on the fact that you'd get a 50% adjustment for the wages you pay, or 20% of the
gross
sales, whichever is less, limited to 20%. So let's put it simply. Let's say you had gross sales of $200,000. All right. So 20% of that would be $40,000, and you have no wages. You get no deduction.
Right.
Okay. So part of what we wanted to do today is talk to people who maybe have small businesses who don't have wages, and maybe they've been paying independent contractors to rethink, whether they really should, or maybe you've been leasing your employees. There's a lot of businesses that use leasing companies. If you've been paying a leasing company to manage your employees, you might want to terminate that relationship, because in order for you to get this pass-through deduction, you have to have wages.
Right.
And this is just basically, I've discovered with the IRS, there's always a yin and a yang, and a reason that they did this. They'll benefit, the IRS will benefit if you turn the contract laborer into W-2 people, right? No, not really.
Supposedly the contract worker would be paying their FICA,
right? Yep.
But I think what they're saying is, in order for us to give you kind of an a blessing, so to speak, of being self-employed, you have to actually be hiring people.
Right.
If you're not hiring people and it's just you with your shingle out in the front, they're not going to let you do this, which also means that if you're a personal service company, all right, so let's say that you're a big accounting firm, all right? Let's say that you're Paychex,
okay,
right? And they have millions and millions and millions of dollars of gross volume, and as far as I can see, they would be a personal service company. Chris, couldn't you?
I would imagine, right? Correct.
And you have millions of dollars in payroll, but you're a personal service company, so you're not allowed to get the pass-through at all.
Sad.
So personal service companies would be like doctors, lawyers, financial people, your financial planner, us.
But am I right? Am I right? Those personal service corporations could have the pass-through if their income is less than $300.
Right. And so that's that other phase through, that other exception. But if you're a personal service company, like let's say you're a doctor, and you make less than $315,000 if you're filing a joint return, AGI, or $157,500 if you're single. Okay, then, and there's a phase out, okay, then you may get part of the pass-through if you come under those restrictions, if you have wages.
Okay.
Right. No wages, no nothing.
No ticky, no washy.
And that's why it all starts off with wages.
Right.
Yeah.
And then also, not, saying that personal service corps are gonna get screwed, but they're gonna get screwed, because also what they're doing in the new tax law is that your net profit before, if you were an S corp, would flow over to your personal return, and you would only get taxed as ordinary income. You're now going to get taxed as self-employment income on your net profit as well.
Right, but if you were getting reasonable wages, that should be you're still limited to the $110,000.
Right, but what I'm saying, so maybe you took out $80,000 from the company.
Right. You're absolutely right.
You now, if you got to pay the other.
You're absolutely
Social
right.
Security and Medicare tax. So.
Right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Yes.
And then that comes with it, planning. And I think that's the key
and
thing.
that's what we're going to talk about. But
planning.
Anyway, we got Mr. John from Tonawanda calling. Hey, John, how can we help you, sir?
Esther, I got two questions.
Yeah.
2018, is capital gains rate the same as 2017?
Yes, with some very minor modifications because of the change in the tax brackets. But basically, it's going to be the same, yes.
And a second question, what is the Medicare cost per month?
I don't know.
Oh, out of your Social Security?
Why don't you Google that? What Chris is going to do is Google that, and he'll let you know in the next couple seconds. Okay, John?
Okay.
All right, have a Happy New Year.
Thank you.
All right, thank you. Bye-bye. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. But everybody did get a little increase in their Social Security because of the cost of living.
Yeah, I'm texting Tim to our healthcare navigator to see if he knows about the cost of Medicare.
Okay, so now here's the other thing. Let's say you're an employee and you were getting reimbursed from your employer for outside sales or for travel, or if you have to go out for the company, and let's say the employer said, we're going to give you 50% of your expenses, and the rest of it you could have taken as a miscellaneous itemized deduction. That since that's not going to be deductible anymore, that can effectively hurt you very much. Well, one of those things that I think employees need to talk to their employer about is how to remunerate them in such a way that they're going to get all of their money for their expenses that wouldn't have been deductible as a reimbursement, which would not be taxable to them, which would be 100% deductible to the employer, but it's just a different way of getting reimbursed.
That's right. That's exactly. I have. Sorry, Chris. Go on.
It looks like it's going to be $134 for Medicare coming out of your Social Security a month.
Okay, so that is to help our last caller. $134 for Medicare. Chris Googled it and found out.
And Tim might call in the show in a second, he said.
Okay.
And tell you the price.
And then it also goes up depending on your income.
Right. If you have higher income, the Medicare portion, your contribution goes up. If you have higher income.
I had a client the other day, and he was referred to me by his father, and he's a lawyer, and he used to work for an employer, and he drives all the time, and now he has switched to another employer, and he's driving all the time again. I don't understand what the lawyer who's driving all the time, but he's driving a lot.
Well, going to court, right?
That's true. And so he doesn't get any reimbursement for his miles. And his employer said, just take it on your tax return. And that's how you will be compensated for it. You could take the 2106 on your tax return. But the truth is, in 2018, that's not an option.
Right.
So,
in 2017, that'll still be deductible.
Right.
So those of you that are used to taking your expenses, office and home, expenses, continuing education, the cost of your stockbroker as a miscellaneous item, on 217 you can still do it. 218 it's gone. And that's why it's so important that we have this conversation now so we can talk to your employer now so they will change the way they're paying you. And basically what you would do is you might take, let's say your expenses run $100 a week. And the employer was just saying, well, put it on your tax return. Now, what we're suggesting is have the employer give you a $100 a week pay cut, okay, and reimburse you for your expenses. You fill out a little expense sheet and have them pay you the $100 as reimbursement. You stay 100%. You stay 100% remunerated, same as before. You actually save FICA and taxes on that money, right?
Right.
And the employer gets to take the whole thing. And it's a different way to skin the cat.
That's Tim on hold. They didn't label it.
Oh, okay. And we got Tim Eliason. Hey, Tim.
Hi, how are you?
Good. You sound like you're in a tunnel.
Hold on.
Live radio.
All right. Hello, Tim?
Hold on.
Okay.
The question was, somebody called in and wanted to know what the Medicare costs will be going forward. Do you know?
217, it goes up to $132 for Part B, what that would come out of your Social Security.
You mean 218?
For 218, yep.
Yeah, okay.
Yep.
$132 for Part B.
Okay.
That's good to know. That's exactly. And what's the increase? Is that a large increase from 17?
Yeah, it is. Basically, what happened is they got their little letter that said that they got their increase in their Social Security benefit, and everybody thought they got a raise, and they turned around, and the same percentage as what the increase was in their Medicare costs.
Wow.
It kind of nets out to be nil.
Okay, well, I think we're going to go to a break. Go Bills.
All right, Tim, thank you. That's Tim Eliason. He's their assistant district manager and our healthcare navigator.
Right.
And so if you're having Medicare questions, if you're somebody that's turning 65 and you need to consult about what's available, EG Tax is there at no charge to help you to find your best solution. Yeah.
I was going to say, even if you're having problems with the New York State Exchange, if you're under 65, we have people to help you with that too.
That's true. So getting back to our focus here today, we're talking about the changes in pass-through deductions, where they're going to go, who's going to get them, how they're computed. And if you are somebody that is either an employee of a company where they were paying you on the side to get reimbursed, or you're an employer and you have any questions, or you have any questions about the changes in tax law, 8030930, 8030930, star 930 on a cell phone. And I think, are we breaking right now for news? Yes, we are. And we're going to break for news, and we'll be back on the other side. This is Esther Gullias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We want to help you to understand it's kind of out with the old and in with the new, but you got to do the old before you can do the new. And so I have been studying this stuff for the last week like a maniac. But here's the thing. If you're a small business owner, okay, if you're an employee of small business owner and you're getting reimbursed, we talked about we will help you with your employer to understand what to do so that they're 100% compensated and you're 100% compensated, because next year in 2018 you're gonna get it in the neck if you don't do something about it. All right, that's number one. But number two, the small business owner can get a pass-through deduction, and everybody's been talking about it, the 20% write-off. Now, let me tell you how it works. Let's say you had $1 million in gross sales and a $600,000 wages that you had paid out to make the $1 million in sales, okay? The pass-through would be either 20% of the million, which would be $200,000, or 50% of the wages, which is $300,000, whichever is limited to 20%. So the $200,000 would be a pass-through. The pass-through is not a pass-through against the income on a Schedule C or on the 2106. It's actually a below-the-line adjustment. And by the way, Chris, I read it was a below-the-line adjustment. It's a below-the-line adjustment after AGI. So that means that $200,000 would then be taxed by your tax bracket. If you're in the 25% bracket, you'd actually save $50,000 in taxes.
Wow!
So that's on $1 million. But let's bring it down to normal people.
Right.
Let's say you had income of $200,000, right? At 20%, that's a $40,000 potential pass through. But you have no employees.
Right.
Or maybe you only have employees of $10,000. So you're going to get half of the 10, which is 5, or the 20%, whichever is lower. So your pass-through is going to be 5 below the line after itemized deduction multiplied by your tax bracket. If you're in the 15% bracket, you'd save $650. That's just to put it into perspective.
That's if you itemize.
Well, see now, that's the only thing.
Where are they going to put it?
I don't know. And right now,
what are they going to do?
We haven't seen how they're going to handle it. One article I read, they thought it's going to be a miscellaneous itemized deduction like gambling, not subject to 2% if you itemize. Then another one said maybe they're going to take it below the line just after AGI, because you're still going to have to pay the FICA on the whole thing.
It's sort of a wait and see.
But the whole thing is, here's the thing. If you say, okay, well, I have all freelance employees. I have not employees. I have all freelance let's say carpenters and stuff, and I have $100,000 in 1099s. Well, maybe I want to convert them to employees, but then you have to pay the FICA, half of their FICA, 7.85%, workers' comp, right? New York State unemployment. And so the benefit, so before you go running off and doing something half-cocked, call EG Tax because we'll help you at no charge, right? Let us go to the phones, and we will talk to Ray in Amherst. Hi, Ray.
Hi, Esther. Comment and a question. One is, just to be clear, Tim said the Medicare was 132, and your other guest said it was 134. It is 134. It's not 132.
Good job, Chris.
Yay, Chris.
Google.
Thank you, Ray.
Thank you, Ray.
Clear that up. And the other thing is, if you could talk a little bit about master limited partnerships and their distributions, because I had some in a IRA account, and what I didn't realize is that anything more than $1,000, you get hit with a 15%. It starts kicking in on dividends. Anything more than $1,000 in the IRA apparently gets hit with a 15% tax. So it's not. I don't know if you're familiar with master limited partnerships or not, but
well, are you saying this is this is when you take the distribution, or is this a tax on the master limited partnership by what entity?
By the U.S. government. I mean, what I'm reading is, maybe you could clear it up, is that keeping an MLP in your IRA is not good.
Not gonna help. You know what? I will tell you. I've been concentrating on all the pass-throughs and the limitations and who's going to do. I will do the Master Limited Partnership research this week, and next week I'll have the answer for you.
Or
you can call during the week. I'll probably know in the next hour, but I can't do it on the radio.
She's like, that's all she does is research the new law. So
because I really want to know. So you can call us Monday, 632-7886. Wait till next Saturday. I'll announce it on the radio. And that one I hadn't heard of.
Yeah, the master limited partnerships, because they're high yielding dividends typically. And, they suggest to hold it outside of an IRA in a regular investment account. So if you could do a little...
I will do the research.
...tweak on that.
I will.
Let people know.
I will, sir. Thanks for calling.
Bye-bye.
Happy New Year. You can only do what you can do, but we will find out. Okay, let's go to Francis and Clarence. Hi, Francis. How can we help you?
Hi, everybody. I'm a full-time rental property owner. And
yep.
There's things like, the carpet installers, the plumbers, that's all deductible. I guess the only thing, I don't have any employees per se. I guess I should say that. It's just me. I hire everyone out. But the one deduction I am curious to know is mileage for me. I know you were talking about it with other people, but I've been keeping track of mileage all these years. Is that...
You're still good. Here's the thing. There were Schedule Cs for people that are self-employed. Partnerships for people that are in a partnership, people that have rental property, that's another form of business like you're in. All of those entities are entitled to take their expenses for travel because they incur them legitimately making money. Who really got taken to the water shed or to the back barn or whatever were people that were employees driving around for their employer, who used to be able to take their employee business expenses. The deduction for employee business expenses is now eliminated. And the only way that an employee is going to make out is through the employer, and that's where we want to help people. But you, as a property owner, still get to take your...
As a rental property owner, Francis, there's no change for you.
Right.
And you don't have to worry about making anybody employees. There's of no consequence for you.
Okay?
Great. I do have one more question.
Yeah.
Okay. As far as, I do work out of my home, am I allowed to take some cost of utilities or anything from the home, or is that because of rental property, I'm not allowed to?
So do you work for home for your rental property or for your W-2 job?
No, I work from home. I mean, it's like I have an office at the house.
For your W-2 job?
No, for his rental property.
For his rental property. So there has to be a room in your house that you use solely and exclusively, but you can't take that for a rental unless you had it as a business, and that's not the case.
But the rental property is his business property. So if you do have a room that you use regularly and exclusively for your rental property, and it's not just like Aunt Thelma living upstairs, it's really a business, then that percentage for your office and home would be a bona fide deduction.
Is it based on square footage?
Square footage of your home, right.
Okay, thank you.
You're welcome, Frank. Bye-bye.
And, sorry, just to let you know, on the MLP, if the total earnings exceeds $1,000 from your K-1, the IRA has to issue a 990T, which you have to pay tax on now, even though it's in a retirement
And
account.
that's for Ray.
That's for Ray.
That's the beginning
so
of
the
his...
earnings of an MLP for no special tax is under $1,000.
All right,
Once it
so
hits $1,000.
if you have a master limited partnership that's holding your IRA, that would not be very good, because then you'd end up paying taxes now, and you'd have to keep track of that adjustment to basis, wouldn't you?
I would imagine it could really...
Oh, it would be terrible.
Yep.
So what you need to do, Ray, is talk to your broker about rolling over the money in your MLP to another investment if you don't want to keep track of that basis and pay those taxes on that. But we'll do more research this week too. Okay. All right. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on the cell phone, and we got Rob in Tonawanda. Hey, Rob.
Yes, Esther.
Hi. How can we help you, Rob?
Oh, yes, I'm sorry. I was just wondering, for 2018, do seniors over 65 still get that extra $1,250 on the standard deduction or not?
They do. I think it's $1,300, isn't it, Chris?
I know they kept it in there. There was talk about getting rid of it.
But it's in there.
Still there.
It's still
we just don't know the dollar
we,
amount.
We thought they were going to get rid of it. They kept it in there at the last minute. So yeah, we're still
about
good. Thank God.
$1,300 for over 65
Right.
each for you and your spouse if you're both over the age of 65.
So that's a happy day. So you'll have the $24,000 plus your
And that's
additional
a
standard
really good
deduction for being
question.
over 65.
Yeah. Oh, great. And one other quick thing. As far as like for rental properties, as far as your rental income and expenses, I know there's a Form 8825 that we do, and usually we have a small loss at the end of the year. You know, it's nothing. It's a Florida.
Oh, is it through a partnership or a corporation that owns the rental?
Yes, we are.
That's why it's on the 8825.
All right.
So are those deductions still going to be allowed for 2018?
Absolutely. Yeah. As long as you are trying to make money and you're not renting it to a relative, then you're still going to take those same expenses. They really didn't touch the income. All the income is the same except for the pass-through for Subchapter S's, partnerships, and what else was it? Partnerships, Subchapter S,
LLCs.
and LLCs. Yeah. So rental property is the same. All the other 21 lines of income on page 1 of the 1040 is all still there, and the way that got there is still the same. So, but as a matter of fact, they liberalized the deductions though for many small businesses. So that'll help people going forward as well.
Okay.
Okay.
Your healthcare consultant. What number can he be reached at?
It's 632-7886 during the week. His name is Tim Eliason. 632-7886.
Okay.
Tim with a T?
Tim with a T.
Okay.
Yep.
Thanks, Rob. Happy New Year. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. They've changed 1031 exchanges. If you're somebody that has been doing exchanges, that has changed. We want to talk about that. And we want to talk about whether or not you should change your business form, whether you should go from a C to an S corporation. And we'll talk about that on the other side with your questions. 8030930.
The bills make me wanna shout, kick your heels up and shout, throw your hands up and shout, throw your
Yay, Frankie! Ray J!
Hey, I hope the Bills win.
Bills.
I'm afraid. I mean, I don't know about you guys, but I watch the Bills play in the closet. I literally go in a closet.
One eye open,
and then I listen to hear
closed.
if people scream. If they scream and it's a happy scream, then I think, oh,
I
we did
do
good.
that.
If it's a bad scream, then I know we did bad. And then as it gets close to the end, if we're way up, then I know we're going to blow it. So I stay in the closet. When it's all over and I can only get my heart broken once, then I find out. I know that sounds so sick, but I'm
think a lot
very
of people do
invested
that.
in the Bills. I'm very invested in them.
I remember, this is going to date me, when we used to have those bumper stickers that said, "We're talking proud."
Yep.
Yeah. Because we
Yep.
really care about them.
I know. Well, let's go with the phones, and then we'll talk the rest of our tax law change here. Hey, Anna, how can we help you, my dear? Anna Banana.
Hi.
Hi, how can we help you?
Hey, I had a question. My husband and I didn't work at all in 2017.
Okay.
But we did in 2016, and a profit-sharing check was issued to him, but that came in January of 17. Now, how will that be treated?
That's going to be treated as taxable income in 2017. And so I'm assuming if it was a profit-sharing check, you sold the stock that you had. You exercised an option and you sold the stock, correct?
No.
No.
It's through General Motors.
All right. So how much money was it, Anna?
About $4,000.
So they're going to send you a W-2 or a 1099-R, depending upon how it's listed, however they're treating it. And it's if that's the only income you had, then you're not going to have to pay any taxes on it.
Okay. And would we be allowed to put any of that into a Roth IRA?
If it's on a W-2.
If it's on a W-2, you can put it in a Roth, but why would you? It's not going to be taxable anyway.
No,
you can do anything you want with it.
Right. Is there no other pensions or Social Security?
Well, there are, yeah.
Oh, how much is your other income, Anna?
I'd say about $62,000.
Oh, okay. Then I take back everything I said. It's going to be taxable, and you're going to have to pay taxes. And I assumed you had no other source of income.
Oh, okay.
Thank you, Chris, for clarifying.
I was thinking that.
So then, yes, if it's on a W-2, you could put it in a Roth.
Right.
Okay. All right. Thank you.
All right. Thank you, Anna. Yeah, I mean, that other stuff is pretty important,
Yeah,
right?
I was getting there.
All right, let's, before we go to our other callers, 8030930, 8030930, star 930 cell phone. All right, so here is, let's say you're a small business owner, you're self-employed. Should you move to a subchapter S corporation?
Maybe. I mean, the payroll thing is a good place to start if you're going to have payroll.
All right. Well, the thing is, you're going to get the pass-through if you have payroll, whether you change your business form or not.
Then usually you
Right?
want to be an S corp,
Right, Chris?
Right. I mean,
if you have payroll and you are self-employed, and it's not personal service income, and if it's not over $315,000, you're filing a joint return, you're going to qualify for pass-through deductions anyway, even if you don't change your business form.
Correct.
Right? And they're going to make you pay your FICA up to the total amount of allowable net profit, anyway up to $110,000 or whatever the wages are going to be this year. Anyway, so that's not going to change. So would you necessarily change your business form? Maybe you would do an LLC just for protection.
I was going to say it all depends on what you do and what's the likelihood of being sued to protect you and your personal assets.
So you would change the business form not for the pass-through, but for the protection.
Right.
Possibly. Right?
Correct.
All right. That's good. All right. The other change that I wanted to make sure we talk about is the 1031 exchanges are limited now, starting in 2018, for exchanges on real estate only.
Okay.
So when you and I haven't gotten any clarification on this, but I think it would eliminate trading in a vehicle for one, because that's basically a tax-free exchange. You have a business asset and you exchange it on another one, you get the adjusted basis on your business. It looks like that's not going to be the case. So if that's the case, when you exchange your vehicle that's already been fully depreciated and you got maybe $10,000 in a trade-in, that'll be a taxable event as ordinary income. Correct?
Yes. So you have to, before you do anything, call your tax
and
person.
I think Russ Gullo would be another good resource.
Well, but he strictly can only do real estate anymore.
Right.
And you can't do real estate that is like a Campbell's soup where you just have it to flip it.
Right.
So you can't do an exchange on that. So it has to be for real estate for exchange only, not for flipping.
Right.
So that's another change. And the other thing is, we were talking about IRAs. There's been another change on IRAs regarding reclassification. Chris, you want to talk about that?
Sure. What would happen in the past is people would come in and we'd see a 1099 from an IRA, we'll say for $100,000. And we're like, what was this for? And they're like, oh, well, I put everything in my Roth now. I like the idea of tax-free income later.
Move from a traditional to a Roth.
Correct. Right? And we'll say, great, if you like it, that's good. But, you now have a $25,000 tax bill because of this.
Right.
And they're like, what?
Because when you move from a traditional to a Roth, it's fully taxable in the year that you do the conversion. The conversion,
mm-hmm.
Right? And so the big change is
that we used to be able to say, call your broker and reclassify it back to the traditional IRA. Now the IRS said once it's in a Roth, stays a Roth.
Right. So if you pass out when you're having your taxes done this year because your tax advisor says you owe so much money and you weren't aware of it, you can't reclassify.
I just can't tell you. Sitting next to you, your office, my office is literally adjacent to yours, and I will hear you say to your clients, call your broker, reclassify.
But he doesn't want to. I don't care. Make him do it.
Wow.
But unfortunately, now you can't. So the die was cast on December the 31st.
God.
All right. So be very careful
before
if you're
you
a broker.
Make that change.
There's this investment advisor that advertises that on a different station, and he talks about managing your money so when you retire you won't be taxed on your IRAs. And his strategy is to just take it and roll it all into a Roth, which is all great. You're going to pay the taxes now.
Right, at a higher rate.
You're going to pay it now, and you may never have to pay for it later because, number one, the standard deduction and personal exemptions, if you're over 65, is going to be $26,000 that you could take out every year tax-free. So,
not to mention they change tax codes sometimes. We just had a big change in the tax code, and they just lowered the rates. So what's going to happen down the road? Don't do that. And more commonly, your income is less.
Before you move from your traditional to a Roth, call and find out how much it's going to take. It's going to cost you in taxes, because once it's in the Roth, you can't reclassify. All right, let's go back to the phones, and we have Mr. Tony calling.
Tony, happy
Hey, Tony,
New Year.
how are you? Happy New Year.
Yeah, Happy New Year to everyone there. First of all, in President Trump's campaign, he said he was going to get rid of carried interest. That provision still maintains itself in the law. Could you or someone there please explain carried interest and who uses it?
Well, that would be investment interest on when you're, like, for instance, let's give you a very simple example. Let's say that you have a stockbroker and you're borrowing money in order to do investments on a margin account. That would be interest that is deductible, limited to the income that you're receiving. So, but the bottom line is, Tony, it's a collaborative effort, and I don't like when we're going to do the political thing. So if there's nothing we can do about the tax law that was just put into effect.
I think when they're there, they a little yin, a little yang. They fight back and forth,
they do.
And so Trump would have said that he wanted to get rid of carried interest, and so it's like
and Tony, I know that Trump is not your guy. There's a lot of things in the tax code that, believe me, I don't care for, because I hate it that an employee is going to get knifed in the back here. That doesn't. But I'm trying to do everything to help people. So
I appreciate that very much, Esther. But one other thought is, why was Puerto Rico in that bill considered to be a foreign country?
I don't know, Tony. I just. I can only solve the little tax problems that I have. I can't solve the Puerto Ricans of the world. So I wish you a happy New Year. God bless you, Tony. Stay well.
My quick answer to that would be that Puerto Rico has their own tax return.
That's true, and they're possession, and they owe
right.
a lot of money, and that doesn't mean that you wouldn't want to help them. But that's why I'm just a tax person. I'm not a
politician.
Not a politician. I'd probably jump off of a bridge.
Well, I think you would take some with you.
Yeah. I mean, the problems that we face in our country are very complex, have happened over a long period of time, and Tony and I can't solve them right this minute. So if you're on your way to church, pray for me and Tony. I hope you have a wonderful week. I'm Esther Gulias, the tax lady. Welcome to tax season 2018. If you need the best tax help, give EG Tax a call. Visit our website at egtax.com. God bless you. Bye-bye.